I recently hosted a live workshop with my friend Jeremiah Lancaster, who is the founding partner with me of the sales coaching business called hubermethod.com. We did a live workshop. We had over 400 people live in a Zoom room where we discussed sales, how to close, how to gain trust, our 6-step method. And it was a really great webinar. I hope you enjoy. We're going to play it right here live for you. And if you want to reach out to Jeremiah, go to hubermethod.com. Thanks for listening. So now let's talk about the different types of income in the eyes of the IRS and who gets to utilize this bonus depreciation and who doesn't. Now there's something called, I'm going to oversimplify it. Now there's a lot of nuance here, but there's basically two types of income. There's active income. This is what you're mainly focused on, maybe your W-2 job or a primary business that you own. That's income that you actively earn. And then there's passive income that maybe if you're just an investor in a business and you don't have a role in it, you don't spend time on it, it's passive income. Now, if you're a limited partner, an investor in a real estate deal, and you're not what's called a real estate professional, meaning your primary business is not the business of real estate, then you can't use passive losses from real estate investment to offset W-2 income. Now, most of the people that reach out to Mitchell say, hey, Mitchell, I got a tax problem. I make a ton of money in my W-2 job. How can I pay less in taxes and defer more of it into the future? I want to buy real estate. I want to get bonus depreciation. I want to offset my active income. You cannot do that unless either you are a real estate professional in the eyes of the government or your wife or spouse or husband is a real estate professional in the eyes of the government. If one of those two people, marital participation, matches that, then you are a real estate pro and your passive and active losses can offset each other. So an example is I'm a real estate professional. I also own a small business on the side. My small business generates about $1 million of taxable income for me every year. But I also have made a lot of real estate investments. I own a lot of real estate and I got $2 million of the bonus depreciation passed to me last year. I actually can shield and defer the taxes from my W-2 main business and some of my other side businesses to defer more taxes. Works out great.
Yeah. So, this gets into the title of this slide is almost like, why should I not do this? And, the one big reason is you just can't utilize the losses. So, real estate rental income is passive by nature. And so if you don't have other passive losses to utilize, or you're not a real estate pro, you just shouldn't do it. It will not provide an immediate benefit unless you have other passive income going, or unless you have some other big strategy. I mean, ultimately talk to your CPA about doing this. Other reasons you shouldn't do this. Again, you're in a low tax bracket, or, the payback ratio is just not good because the property is too cheap, or you're going to immediately sell it. I mean, this is a deferral. So if you're going to go turn around and sell it.
Let's talk a little bit about what it means to be a deferral. So
yeah,
how should we think about this money that we are saving? And you taught me this. I'm going to kind of repeat it as simply as I possibly can. You told me that, hey, Nick, look, we have this year bonus depreciation. It offset about $700,000 that you would have paid in taxes. $700,000 instead of paying that in taxes, you kept that money, $700,000. So look at it as an interest-free loan from the government, meaning you are going to someday owe Uncle Sam this money, whether you sell the asset. Eventually, when you sell the asset, the basis is going to be reset. We're going to talk about recapture in a second. You're going to owe the money. So would you rather pay the $700,000 now, or would you rather pay the $700,000 in 5 years when you plan to sell a building? The answer to me as a real estate investor, and knowing how valuable capital is and how I can actually grow that capital, make more investments, the answer is pretty clear to me that I would rather defer the taxes into the future. But if I were to sell my asset next year, maybe I'm a house flipper, right? Maybe I buy a house and then I want to sell it the very next year for a profit. A cost segregation study and bonus depreciation, all these things we're talking about kind of go out the window. The government here is incentivizing us to hold on to real estate and take care of it for a long time. So that's what they want us to do. So if I were to flip and sell real estate quickly, these tax advantages, almost all these tax advantages that we're going to talk about in this presentation, actually don't really work.
That's right. I mean, you're getting into this kind of, again, esoteric tax idea of what you're really creating is a deferred tax asset. So, like, meaning you took a deduction today that you weren't ordinarily entitled to until, 39 years from now, when you blew this whole building apart and pushed the depreciation way forward. And so you really, or no, sorry, you're creating a deferred tax liability. So like, you owe the money in the future. The IRS is loaning you money. They just don't know they're loaning it to you. It doesn't really, like if you were Starwood, if you were a big REIT or a big public real estate company, you can go look at their balance sheet and see a deferred tax liability sitting on their balance sheet. But you are just, shooting your, net worth statement to your bank. This deferred tax liability doesn't show up on there, but it exists. I mean, when you sell the property, you're going to owe the money, but you're getting to use the money rent free. And today, you can get a real return of 5.5% risk free.
Big news, guys. I created a free PDF that details my method on how I analyze a self-storage facility and figure out what it's worth. Give me a pen, the back of a napkin, and a couple metrics, and I can figure out about what the property is going to be worth to me. If you want to download this PDF, click in the show notes, the first link, and you can give me your email address, and you get a email right away with 4-page PDF that outlines exactly how I think about underwriting or giving my initial analysis on a self-storage facility. Again, click the link in the show notes, and you're going to get that document for free. This episode of The Nick Huber Show is brought to you by RE Cost Seg. If you want to maximize your bonus depreciation and minimize your tax liability, make sure to do a cost segregation study on real estate you've recently acquired. RE Cost Seg offers the lowest priced, fully engineered studies in the business, and you get a virtual site visit with a quick turnaround. They did 30 plus cost seg studies for me over the past year, including a short-term rental along with my self-storage facilities. And I'm also an investor in the business along with my good friend and CPA, Mitchell Baldridge, who you all know. To learn more about how bonus depreciation works, listen to episode 75 of The Nick Huber Show or visit recostseg.com to go ahead and get a free proposal that outlines the cost of the study and your potential savings. Thanks again, recostseg.com.